Have you noticed words like sustainable and green on your banking app or pension letters? Every UK bank and fund is suddenly talking about saving the planet. But is this real change or just clever marketing? Let's cut through the noise and see what's really behind the green wave in UK finance. So, why is this happening now? A big part of the answer lies with us. Public awareness about climate change has never been higher. We see the effects of a warming planet in the news every day, from extreme weather events here in the UK to devastating wildfires and floods around the world. People are increasingly concerned, and they want to make a difference. This desire isn't just limited to recycling our household waste or cutting down on car journeys. People are starting to look at their money and wonder if it could be used as a tool for positive change, rather than contributing to the problem. This growing public pressure is a powerful force. Savers and investors are asking more questions. They want to know where their pension is invested. Is it funding fossil fuel companies, or is it supporting renewable energy projects? They want their bank to be transparent about its lending practices. Is it financing businesses with poor environmental records or questionable labour standards? This demand from customers is something the financial industry simply cannot ignore. If enough people say they want sustainable options, banks and fund managers have to listen, or risk losing business to competitors who do. It's not just about public opinion, though. Governments and regulators are also playing a huge role. The UK government, for instance, has set ambitious targets to reach net zero carbon emissions by 2050. To achieve this, the entire economy needs to shift, and that requires massive investment in green technology and infrastructure. The financial sector is seen as a critical engine for this transition. Regulators are introducing new rules that require companies and financial firms to be more transparent about climate-related risks and their environmental impact. This regulatory push is forcing the industry to take these issues seriously. Finally, there's a growing belief within the financial world itself that sustainable investing is simply smart investing. The thinking goes like this. Companies that manage environmental, social, and governance factors well are more likely to be well-run businesses. They are better prepared for future risks, like new environmental regulations or shifts in consumer behaviour. They might also be more innovative and efficient. Therefore, investing in these companies isn't just about feeling good, it's about potentially achieving better long-term financial returns. This argument has helped move sustainable investing from the fringes to the core of financial strategy. The UK's banks and investment funds are rushing into green finance. Why now? It's a huge business opportunity. Trillions are managed under ESG principles, and customers want green products. But it's also about risk. Climate change threatens economic stability, and reputation matters more than ever. The real question: how deep does this commitment run? ESG stands for Environmental, Social, and Governance, a framework investors use to judge companies beyond profits. It's about impact. The E is for the planet, the S for people, and the G for how a company is run. Together, they show if a business is truly responsible. Green bonds are loans, but the money raised must be used for environmental projects like wind farms, solar parks, or public transport. Issued by governments and companies, green bonds offer investors a clear link between their money and positive environmental impact, with transparency and accountability at their core. In the UK, green bonds help fund eco-friendly projects. Imagine a water company raising money to build energy-efficient plants and fix leaky pipes. They issue a green bond, verified by experts, so investors know it's truly green. Each year, the company reports how the money is spent and the environmental impact achieved. UK banks and funds are embracing sustainable products because the public is demanding them. People now want their money to reflect their values. Climate, social justice, and ethics matter. This isn't a fringe movement, it's mainstream, especially among younger generations set to inherit wealth. Millennials and Gen Z are quick to switch banks if they find out their money supports fossil fuels or unethical practices. Financial institutions know they must adapt or risk losing customers. The conversation has shifted. Investors now ask about impact, not just returns and risk. Advisors are expected to discuss a fund's carbon footprint as easily as its performance. As demand grows, more sustainable products appear, creating a feedback loop that pushes ESG into the spotlight. Banks aren't leading the change. They're racing to keep up with a public that's voting for a greener, fairer future. The power of public demand is reshaping the financial industry from the ground up. Let's be honest, profit is still the main driver for most financial institutions. Sustainable investing is a booming market, worth trillions and growing fast. Banks and funds see ESG products as a way to boost revenues, often charging higher fees for green funds. The business case is clear: meet customer demand and increase profit margins. Innovation is rampant. Think green mortgages, eco-savings accounts, and thematic funds. Each new product is a chance to attract customers and grow market share. The profit motive isn't all bad. It can accelerate positive change when big players invest billions in sustainable platforms. But investors must stay alert. Some products are genuine, others just cashing in on the trend. The challenge is to separate real impact from clever marketing. In the green gold rush, not everything that glitters is truly sustainable. Beyond profit and demand, banks push sustainable products to manage risk. Climate change and ESG issues are now seen as direct threats to long-term returns. Regulators like the Bank of England require firms to report on climate risks, no longer optional. Reputation matters. Being labelled a dirty lender can spark boycotts and damage brands. Employees want to work for responsible companies, so banks promote their ESG credentials. Offering green products is now about self-preservation as much as saving the planet. Fund managers shift money from high-carbon assets to renewables to protect portfolios. This isn't just about meeting demand. It's about avoiding financial and reputational harm. The industry's focus on risk and reputation is driving real change, even if the motives are mixed. Sustainable finance is now a core part of managing both money and image. With billions flowing into sustainable investments, skepticism is healthy. Critics warn that much of the green revolution is just marketing. Greenwashing is rampant. Banks may promote green bonds while still funding fossil fuels behind the scenes. Vague language and aspirational claims often mask a lack of real impact. Some funds include companies with questionable records, disappointing investors. The ESG movement can look like a PR exercise, deflecting criticism and avoiding tougher regulation. This creates a false sense of progress while systemic issues persist. Investors must look past the green labels and ask tough questions. Not all sustainable products are created equal. Some are just old products in new packaging. True change requires more than clever marketing. It demands real accountability. One major challenge in ESG investing is unreliable data and ratings. Different data providers use different methods, leading to wildly different scores for the same company. This lack of standardization confuses investors and makes comparisons tough. A company might be rated green by one agency and a laggard by another. Many ratings focus on how ESG issues affect a company's finances, not its real-world impact. A fossil fuel company with good risk management can score high, despite harming the environment. This inside-out approach fuels greenwashing and misleads investors. Funds may protect your money from climate risks, but not actually help solve climate change. The disconnect between expectation and reality is a major pitfall. Regulators are trying to fix this, but for now, investors must tread carefully. How can UK investors avoid being misled by greenwashing? Start by digging deeper than the fund's name. Check the fund's official documents. Look for clear objectives and transparency. Genuine funds proudly list their holdings. If you see oil giants or fast fashion, be wary. Review the fund's voting record and engagement policy. Active investors push for real change. Look for detailed impact reports, not just glossy promises. Be skeptical of funds promising high returns with no trade-offs. Sustainable investing is complex. Trust managers who admit challenges and are transparent about their process. Avoid funds with vague language and lack of measurable outcomes. A real commitment to sustainability is backed by honest, detailed reporting. In the end, informed investors are the best defense against greenwashing. In the UK, the Financial Conduct Authority, or FCA, is the main regulator making sure sustainable investments live up to their name. Their goal? Build trust and protect consumers from greenwashing. The UK is also developing a green taxonomy, a classification system to define what counts as truly green. International standards, like those from the ISSB, help keep things consistent worldwide. But the rules are still evolving, so investors must stay alert and do their own research. The Financial Conduct Authority, or FCA, is cracking down on greenwashing in finance. In 2023, it introduced new rules: sustainability, disclosure requirements, and investment labels to make green investments clearer for everyone. 4 distinct labels now help investors understand a fund's true sustainability goals, while strict disclosure rules ensure transparency and honesty. Plus, a new anti-greenwashing rule lets the FCA act against misleading claims, protecting consumers and building trust. UK banks and funds are under intense scrutiny as regulators crack down on misleading green claims. The FCA and Advertising Standards Authority have already taken action, including banning HSBC adverts for omitting key information. Now, official bodies are holding firms accountable, making greenwashing much riskier for UK financial institutions. For many UK investors, ESG funds and green bonds let you align your financial goals with your values, avoiding industries like fossil fuels and supporting solutions to climate change. Sustainable investing can also mean better long-term returns, as companies with strong ESG credentials are often more resilient and innovative. With green bonds, you see exactly how your money makes a positive impact, offering both transparency and a sense of purpose. ESG and green bond investing offer promise, but UK investors must watch for risks like greenwashing, higher fees, and limited diversification. Excluding sectors can mean missing out if they perform well, and higher costs may not guarantee better returns. Patience is key, as sustainable investing may lag behind traditional benchmarks in the short term. The world of sustainable investing is complex, filled with opportunity and potential disappointment. ESG funds and green bonds offer a chance to align your portfolio with your principles. But beware of marketing hype and greenwashing. Approach with informed skepticism and curiosity. Read the small print and question fund fees. Green bonds promise measurable impact, but diligence is key. Balance financial goals with ethical convictions for a rewarding investment journey.